Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Doximity Inc. quarterly report. Doximity Inc. offers a wide range of services to medical professionals in the United States through its digital platform. The company provides various tools that enable collaboration among colleagues, keeping them updated with the latest medical news and research. Members can also manage their careers and on-call schedules, streamline documentation and administrative paperwork, and conduct virtual patient visits. The company's primary clients include physicians, nurse practitioners, physician assistants, medical students, pharmaceutical manufacturers, and healthcare systems. These services are designed to cater to the diverse needs of medical professionals, from staying informed about the latest developments in medicine to managing their daily tasks efficiently. Doximity Inc.'s stock price crash. A year of disappointment. The past year has been tumultuous for Doximity Inc. Dox, with its stock price plummeting by over 40%. The decline can be attributed to several key events that have shaken investor confidence in the company's growth prospects. One major contributor to the crash was Doximity's disappointing revenue guidance for fiscal year 2026. Despite beating analyst expectations in some quarters, the company issued a weaker-than-anticipated outlook for the fourth quarter and full fiscal year. This shift from a growth-at-all-costs strategy to one prioritizing profitability and cash flow raised concerns about slower top-line growth. Furthermore, Doximity's net income declined in the third quarter of 2026 due to increased marketing expenses, which rose by 27% year-over-year. The company's investments in AI and other initiatives contributed to operating expenses growing faster than revenue, contracting its net income margin from 44.6% to 33.3%. The broader market volatility impacting technology and healthcare stocks also played a role in Doximity's stock decline. Investors reevaluated growth prospects amidst changing economic conditions, while concerns about potential disruption from artificial intelligence, AI, in the tech health software sector further eroded investor sentiment. Additionally, Doximity's cash reserves saw a significant drop from $915.7 million on March 31, 2025, to approximately $735.1 million by December 31, 2025. While the company reported exceeding expectations in some quarters and highlighted strong engagement with its AI tools, the cautious outlook on future revenue growth proved to be a significant concern for investors, triggering the substantial stock price correction. Doximity Inc. market capitalization of $6 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Doximity Inc. holds a significant advantage in their industry. Doximity Inc. trades at a lower price-to-earnings ratio of 28 times and a higher price-to-book ratio of 5.81 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 14% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the growth side, subscription revenue has been a significant contributor, with an increase of +8% in Q3 and +15% in Q9 2025. Sales compensation on new arrangements with customers has also seen substantial growth, reaching $6.7 million in Q3 and $11.3 million in Q9. The addition of new customers and expansion of existing ones have further boosted revenue, resulting in a $60.9 million increase in subscription revenue in Q9 2025. On the other hand, revenue decline is primarily driven by decreases in other income, net, due to lower yields earned on cash equivalents and marketable securities portfolio. Additionally, a decrease in deferred revenue has also contributed to the decline, amounting to minus $48.1 million in Q9 2025. These factors have had a significant impact on the company's revenue growth. It is worth noting that the growth drivers of broad physician usage of commercial solutions, increased adoption of digital tools and workflow solutions, and high-value customers with at least $500,000 of revenue have all contributed to the company's revenue growth. However, these positive trends are somewhat offset by the decline in other income, net, and deferred revenue. Net income and profit margins. A shift in performance. The financial performance of a company underwent significant changes between the 3 months and 9 months periods ended December 31, 2025. Initially, net income decreased by $13.6 million, resulting in a 22% decline to $61.6 million for the 3-month period. However, this trend reversed when considering the 9-month period, where net income increased by $16.2 million, representing a 10% growth to $176.9 million. The profit margins also experienced fluctuations during this time. The gross profit margin remained stable at 90%, but operating and net income margins saw significant declines. Operating income margin decreased from 48% to 38%, while net income margin dropped from 45% to 33%. These changes in profit margins can be attributed to increased expenses, including acquisition costs, stock-based compensation, depreciation, and amortization. The reasons behind the decrease in net income and margins are multifaceted. Increased expenses, such as those mentioned above, contributed to this decline. Additionally, a provision for income taxes, impairment charge, change in fair value of contingent earnout consideration liability, legal expenses, and other income, net also played a role. These factors collectively impacted the company's financial performance, leading to the observed changes in net income and profit margins. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the extracted summaries, net cash provided by operating activities was $216,936 in 2025 and $174,778 in 2024. This suggests that the company is successfully converting its profits into cash, which is a crucial indicator of financial health. The confirmation on page 43 further reinforces this conclusion, providing clear evidence that positive operating cash flow has been achieved in both years. Management is optimistic about the company's outlook, citing 3 key strategies to drive revenue: marketing solutions, hiring solutions, and workflow solutions. They plan to invest in cloud infrastructure and customer support organizations to fuel business growth, while maintaining a steady gross margin. In terms of expenses, research and development costs are expected to rise as the company expands its platform and product offerings. Sales and marketing expenses will also increase, becoming the largest on an absolute basis, driven by efforts to acquire new customers and sell additional solutions to existing ones. Management is confident that current cash reserves will be sufficient to cover working capital and capital expenditure needs for at least the next 12 months. However, they acknowledge the possibility of seeking additional equity or debt financing in the future, although they cannot guarantee it on favorable terms. Overall, management's strategy focuses on driving growth through customer acquisition and retention, while investing in research and development to support long-term expansion. The company has a history of buying back its own shares. According to financial records, the company spent $417 million on repurchasing shares as of December 31, 2025. This is not an isolated incident, as the company also bought back shares in both 2024 and 2025, with a total expenditure of $434.6 million over these 2 years. The company's decision to buy back its own shares suggests that it has sufficient cash reserves and confidence in its future prospects. By reducing the number of outstanding shares, the company can increase earnings per share and potentially boost investor returns. That concludes the financial summary for Doximity, Inc. Feel free to comment below, and I will be happy to answer them when possible.